Welcome back to the Real Estate Standard Podcast, episode 6, where commercial real estate and Bitcoin collide. I'm your host, Tim Kotzman. Today's January 26th, 2026. Each episode here, we try to break down how serious operators, investors, and developers stay competitive and profitable in the 21st century by examining commercial real estate through the lens of Bitcoin, the lens of evolving capital markets, and the lens of long-term financial strategy. Well, today's episode, we're diving into institutional Bitcoin infrastructure, covering on-ramp Bitcoin custody, multi-institution custody models, and on-ramp's partnership with Arch Lending with Jackson Mikalic. So Jackson, welcome. And first, I'm going to send it over to Kenny for an update on the West Main storage stacking.
Thanks, Tim. What we're looking at today is West Main self-storage's dashboard. And maybe I'll say that again. What we're looking at today is West Main self-storage's dashboard. And we built this so we can keep track of our Bitcoin purchases, and other things like the Bitcoin average cost, our Satoshis per square foot, our weekly acquisition rate, and to keep track of things like our mortgage coverage, how many mortgage payments our Bitcoin can cover. And we got last week's purchase in here that brings us up to 3,614 Satoshis per square foot. Our weekly acquisition rate is just under 10 million Satoshis per week, with an average price of $103,616. And we got our Bitcoin gain for the year at 0.3 Bitcoin. So we're making progress this year. What do you think, Chris?
Slowly but surely, staying humble and stacking sats in the self-storage industry.
So next week, hopefully, we're going to have a new section on this dashboard. We're going to be announcing our first purchase of some digital credit. We were able to open a brokerage account and allocate some of our free cash flow to STRC Stretch, which we're thinking acts as digital rent in the space. But we'll save that conversation for another day. Just a little sneak peek. Chris, do you want to introduce our guest today?
Yeah, absolutely. Jackson, pleasure to have you today. I'm really excited about this topic, and it's something that we've been covering here on the Real Estate Standard the last few weeks. And a big component or a big question we get from the real estate community is, when it comes to a Bitcoin treasury, how the heck do I hold it? And what is the right solution for me, my property, and my investors? So we've spent some time running through those different options. And like I said, I'm excited to have you here today to opine on the sector that you guys specialize in, and why that can be a good solution for, maybe folks in the syndication space, people that have multiple partners on deals. They have different types of regulation and or compliance requirements that they need to adhere to.
Yeah, well, thanks, Chris. I appreciate that. And Kenny, Tim, good to see you guys today. Appreciate the time, and I'm happy to start anywhere. Where would you like me to go? I'm grateful for the opportunity to be on the Real Estate Standard podcast.
We have talked in the past about treasury strategies for real estate owners, right? Diversifying or allocating a portion of your free cash flow into Bitcoin, right? And the big piece there, making sure everybody is, has best practices, is understanding how to store it, right? The ETFs provide certain pros and cons, and then the self-custody has its own components to it. And if you're maybe a one-off investor, husband and wife type of investor, you have small holdings, a signature setup, using your Trezor, your Ledger, your cold card, cold storage is probably appropriate, right? You have the best practices as far as custodying the asset, and you're maintaining that control, right? If you want to, maybe you have some larger holdings, you want a little bit extra security, you want to reduce single points of failure. That's where this multi-signature custody model comes into play. But in my conversations with colleagues and different contacts in the commercial real estate space is the majority of them have outside partners, outside LPs. They have different regulatory and compliance components that they have to adhere to. Otherwise, they get themselves in hot water. That's one issue. The other issue is telling their LPs that we have a Bitcoin position and it's held in cold storage. And that brings with it its own set of questions and everything like that. So that's I was kind of hoping maybe you could address where multi-institution custody (MIC) comes into play and why certain operators, fund managers, and syndicators should be considering that for their next project.
Yeah, you bet. I mean, it's a challenge, right? And in my opinion, it's the biggest problem that needs to be solved in this industry. So even before specifically speaking to the real estate syndicate or the real estate investor, the challenge of Bitcoin custody is the fact that there are no bailouts, right? And there's only 21 million. And so why is that a challenge then? Of course, because Chris, to your point, there's been a couple of prevailing ways to manage the asset. And so you have self-custody, which all of us are well versed in, and I imagine your audience is familiar, Chris, based on some of the previous conversations you've had on this podcast. That's great from a sovereignty perspective, but that starts to break down once you have multiple stakeholders involved. And I see this on the business side from even small mom and pop type businesses all the way, of course, to the publicly traded companies that we work with as well. Once you have multiple stakeholders internally, and then to your point, once you start having to be accountable to external stakeholders, whether it's investors, it's regulators, what have you, it becomes very challenging and, in fact, impossible to manage self-custody. Because if you're a publicly traded company, you're not going to be doing that for a number of reasons. And if you're a private company that's starting to build out a material position in Bitcoin, well, then naturally there may start to be tensions or questions about how are we actually securing this? What happens if something happens to one of our partners? Is there a redundancy in place in terms of accessing the seed phrases, the backups, and what have you? And then you have the question of turnover as well, right? Even in smaller companies, there could still be employee turnover. There could be incapacitation. There's issues that people need to be aware of. And one of the challenges I think is underappreciated in this space is that Bitcoin custody really has not evolved as quickly as the price has moved. And that's hard to do, right? Because the price has moved just so much in the past decade. And what you have a lot of times, and I see this on the individual side as well as the institutional, is people would prefer to keep their existing setup in place and kind of avoid the the discussion point of having to reevaluate custody than actually doing it. And so what you end up finding is a lot of people have setups where they're still managing significant amount of Bitcoin today that's appreciated substantially over the past 5, 10, 15 years, but they haven't really evolved the way that they're managing that infrastructure, whether it's an individual or a business. And so custody matters, of course, because if any company is managing a Bitcoin treasury and Bitcoin is part of the balance sheet, it is part of the capital stack that cannot be afforded to lose. And this is especially true in the context of companies that are deploying actively Bitcoin treasury strategies when they're actively leveraging equity and debt markets to accumulate more Bitcoin. If Bitcoin is the core of your business, then in my opinion, you cannot have a single point of failure. And unfortunately, what most businesses have today is exactly that, a single point of failure. And what do I mean by that, Chris? I mean, having Bitcoin on a single custodian presents a lot of challenges and risks. But the reason why people have done that, Chris, is again, if you're a business or you're a real estate investor, we've already kind of discussed at a high level why self-custody may not be possible, or in certain circumstances, why it may be impossible. So the flip side, of course, has been to manage your Bitcoin with a single counterparty, a single exchange, a single custodian. But with that, it presents a single point of failure. It means that you're solely reliant on the custodian, their balance sheet, their internal controls, their employees, and then the connectivity between you, your account, and the custodian. And so what I found at the highest levels, talking to even publicly traded Bitcoin treasury companies, is what they end up having to do, Chris, is they will have multiple custodial relationships, right? So they recognize I don't want to have all of my Bitcoin sitting on one custodian because if something happens to that custodian, that is going to be a permanent loss. Those assets are irrecoverable potentially. So now I'm going to have multiple different custodial relationships. So maybe I have 25% of my Bitcoin parked at four different institutional custodians. And that way, if anything happens, I'm not knocked out of the game, right? If you're playing in the space, you want to be able to be around for the long term. You don't want to be knocked out of the game. But the problem that arises with that, of course, is once you introduce more relationships, you're introducing a lot of operational complexity in terms of managing the treasury. And so, what I found a lot of times is a solution like ours becomes interesting because you have multiple independent institutions that are securing the asset on behalf of the end investor or the end client. None of the institutions control it. None of the institutions can lose it or be compromised and result in a loss. And it's a unified way to manage the Bitcoin treasury. So rather than A, having to be concerned about something happening to your custodian, you potentially suffering losses, and B, having to manage multiple custodial relationships, you can have one custodial partner, one infrastructure company, one financial services company that helps you manage all of this while you retain control of your Bitcoin. That's an incredibly important point that we can get into more detail on as well. So that's a bit about where it fits in. I'm happy to take it in any direction you like, but I at least wanted to provide context about the options that have historically existed and why there are some of those challenges and risks associated with them.
Yeah, that's super helpful. Thank you for that background. I mean, I think you made a comment there too that made me smirk a little bit, and that was just the inertia that people in the space, inevitably have over upgrading their custody setups, right? And I smirk because the commercial real estate industry is notorious for the same kind of inertia and not being forward thinking, not adopting or even being open to new ways of doing things, new ideas, just innovating in and of itself. So I think if there's nothing that our audience gets today, maybe they can relate to that component just in and of itself. But you also hit on I think a really important point there, and that was the diversification of your custody providers and trying to bring it back to the real estate brain and how these real estate operators are, working day in and day out is when Jackson's talking about the custody provider, it's no different than having your bank is holding X number of deposits for you, or your lender is holding the note to the property, right? Those, more often than not, those are single points of failure. If the bank goes down, if the lender goes down, it's the same situation. What you're doing here is you are spreading your risk across three, even five different parties to mitigate that risk. And I'm sure we'll get into it here, but depending on the situation and the level of sophistication that a particular operator has, you can diversify and hedge all kinds of risk, right? And where I'm going with this, what I'm alluding to is, the jurisdictional risk. Because one thing that real estate folks are, they haven't really acknowledged the challenge just yet, but it's the fact that their assets are immovable, right? They're stuck in the jurisdiction that they're in. As we go through this fourth turning or get further into this fourth turning, and all the risk that comes along with the turmoil and the changing political landscape, the changing tax code, the changing regulatory environment. So while your building is stuck in a particular location, your Bitcoin treasury, it's not only acting as a, kind of I hate to use the word hedge, but it's that, let's use that for now. But now your Bitcoin holdings are spread across different US jurisdictions or even international jurisdictions. And that's powerful, right? I mean, that's something
They're
you
like
can sell.
everywhere,
They're
everywhere
everywhere
and
but
nowhere.
nowhere. Yeah,
Yeah.
absolutely. And
And
that's
I
something that real estate investors, I think they underappreciate that because they have, particularly in the US, right? They haven't had that issue in, the recent past. So, that recency bias is not there. Sorry, Kenny, I cut you off. Go ahead.
Yeah, no worries. I just wanted to add to that before Jackson responds, but just I'm curious as an operator wanting to learn more about the the different parties that you work with to custody the keys and how that's spread out. You mentioned different jurisdictions. Is it different countries, or is it different states, or who are the parties involved? And I think there's three parties, if I'm not mistaken. I don't know if you can dig into that, Jackson.
Yeah, definitely, guys. And great points all around. And Chris, before I go into the jurisdiction component of all this, I did want to just mention to your point as well on the banks, the diversification of banks, deposits, lending partners, etc. It's a great analogy, and it's even more important in Bitcoin, right? Because what we typically have seen is banks be bailed out. And again, just want to reinforce that there are no bailouts in Bitcoin. So the counterparties matter even more than they do in the dollar system. On the geographical component of all this, so maybe to dig a little bit deeper in terms of how this works structurally. So at the end of the day, clients of ours, whether it's a high net worth individual, it's a small family held business, it's a publicly traded company, it's a pension fund, family office, everyone has their own vault. And what I mean by that, it means every single client has their own Bitcoin secured and their own wallet titled to their name, their business's name, their LP's name, however you want it structured. This is incredibly important and nuanced because that means that every single client of ours has Bitcoin that is titled to them in their name and 24/7 visible on chain. So think of, there's a conversation of proof of reserves, and the proof of reserves conversation is in the context of if you have Bitcoin sitting on a custodian, are you able to audit the amount of Bitcoin they have as assets and liabilities? You can think of proof of reserves with on-ramp as just proof of reserve squared, or maybe there's a better way to explain it, but it's just proof of reserves for your individual wallet. So if you're an individual investor that has 10 Bitcoin, you'll always be able to see your 10 Bitcoin sitting in your wallet, and you can verify that off of our platform as well using Mempool or another tool like that, Block Explorer.
Let me just jump in here again for the real estate community. What
Yep.
Jackson just explained is that you can check, you have an app on your phone that you can go and view your holdings, and you can verify that your Satoshis, your Bitcoin are where they say they are. This is not it's not being rehypothecated. They're not lending out your Satoshis on the back end, and collecting a spread like a traditional reserve bank would be doing. Is that a fair point there, Jackson?
I would also add that I think what he said is that you don't need to use OnRamp's app. Like you could go to any block explorer and you could search for that address and you could verify that the Bitcoin is where they say it is, and you don't have to trust Jackson or his team. So it's a little bit better there. And for the real estate folks, they're not commingling your Bitcoin. Your Bitcoin is in a separated, isolated wallet where it's not commingled. Like on Coinbase, they may have um, their own one big XPub, or they may have multiple, but they're storing everybody's Bitcoin on the same wallet for the most part. I just wanted to throw that in there and let Jackson respond.
Yeah, I mean, those are both great points. They're both true. So that's exactly right. Most custodial relationships are omnibus. So to Kenny's point, you have Bitcoin, it sits at the custodian. You don't have great transparency beyond what you log into and see on your dashboard and what it says the number of Bitcoin is. With us, it's segregated, so it's essentially a separately managed account. Only your Bitcoin sits in there. And Kenny, again, to your point that you reinforced, you can actually go off of our platform and you can audit that for yourself. So it's incredibly powerful. That can be done, of course, 24/7. So getting back into the multi-institution custody and how that all works. So again, it's a unified experience. When people hear multi-institution, I think the initial impression that many people have is, well, great, I'm going to have to manage multiple relationships. This is going to be a headache. It's going to introduce a lot of operational complexity. That's not true. So if someone works with us, we have a unified onboarding experience, and they'll go through the process of onboarding with us, and anything else that our partners need lives in one onboarding experience. Once that process is complete, you're going to be working with the on-ramp team. You're not working with the other partners on a day-to-day basis. The only other time you'd be working with other partners is for video verifications and we can talk more about what a withdrawal process might look for. So video verifications, and then the third partner, and we can get into who the partners are, actually never participates in signing, and signing meaning participating in helping you transfer your Bitcoin. They never participate, only in the exception of something happening to our business. So what really we're going to get into the core of now is, why does multi-institution custody actually matter? Why does it exist? Why do we have a successful business? It's because it solves the problem of trust in Bitcoin and the problem of counterparties in Bitcoin. So on the back end, you have a unified experience. You have a wallet that you can view 24/7. That's only your Bitcoin that you acquire through us or you deposit through other means. On the back end, you have three independent custodians. You have our company, OnRamp. We're headquartered in Texas. Our partners, BitGo, that just IPO'd last week, actually. We work specifically with their South Dakota trust company within BitGo Inc. And then the third company is CoinCover. They're based in the UK, and they've also been around for 8 years or so, and they manage billions of dollars of Bitcoin and other digital assets. The other partner as well that people could opt into, getting back into the jurisdiction conversation, is Tetra Trust. And Tetra is the only qualified custodian in Canada currently for Bitcoin. And so what you can kind of see emerge here is the ability to have multiple jurisdictions, not only within the United States, but also globally. And that footprint's only expanding. We're going to continue to expand that footprint over the course of 2026 and beyond. And what you guys will see is actually partners outside of the West. You can imagine, the Middle East, particularly GCC countries are interesting. APAC, you think of Singapore, Hong Kong, Switzerland. There's jurisdictions where you can, Chris, to your point, fourth turning, you can really start to hedge out. You can really start to mitigate any sort of political risk that investors may be concerned about. So right now, we still have that concentration in the US or in the Western world more broadly between UK, Canada, US. But I would argue that is far better than just having your Bitcoin sit in a single custodian in one jurisdiction within the United States. And I actually forgot to tell you the most important point about all this, right? So you have three institutions that manage your Bitcoin on the back end. And if anything happens to any one of those companies, it doesn't result in any losses. It's because you only actually need two of those three companies to be available and accessible for the real estate investor to be able to access the Bitcoin that they own. So that's really the critical breakthrough here. And it's not something we invented. We're using something called multi-signature. Funny enough, going back to BitGo, Mike Belshi was one of the first, if not the first, to implement multi-sig wallets back in the early 2010s. And they built an entire business around multi-signature. BitGo did. And multi-signature just means you have one wallet that has multiple private keys associated with that wallet. And this is the standard for all institutional custodians. Every institutional custodian is using multi-sig for Bitcoin, and Bitcoin only. Multi-signature is native to Bitcoin. What we did, what was novel, is rather than have all the keys live within a single institution like Coinbase or BitGo or Anchorage, why don't you have multiple independent institutions that participate in managing a minority of the overall key set to the extent that none of them control it? And again, none of them can lose it. So that's the big breakthrough here. And that's why we see a lot of businesses and even real estate investors, a couple come to mind just more recently as well, coming on board because they recognize they didn't like the single point of failure and counterparty risk that they previously had with their former custodian.
Yeah. I think the jurisdictional arbitrage is so underappreciated by the real estate community. I mean, I'm here in California, and we're back in the headlines the last few weeks here with this the resurgence of the billionaire tax conversation. And you think about, maybe the individual is a lot more mobile, but these assets that a lot of these real estate investors own and operate, they're long-term holds, right? I mean, we talk about long duration assets. I mean, real estate is exactly that. And these are 5, 7, 10, sometimes 20-year hold periods. And, if they can't tax the billionaires, I mean, who's saying that they're not going to go downstream and put, some kind of punitive regulation on the hard asset itself. So again, I think it's really underappreciated by the industry at large. Yeah, that's important. If we were to, let's just play out a scenario here. I want just how the mechanisms work. So let's say Kenny and I are partners. We operate a fund. We have 100 LPs that we basically speak on behalf of. We own and operate self-storage facilities up and down the Eastern Seaboard. We have a Bitcoin treasury, and we need to move Bitcoin for whatever reason. And we call up you and your team. How does that process unfold? What does it look like?
Yeah, for sure. So we would onboard you, and then once you have the account established, you would log into your account at onrampbitcoin.com. One of you would be the owner on the account, so you'd make a decision with your partners. One of you would be the owner on the account, and that means that you would be the only person who can video verify with external partners. But that does not mean we'll get into the additional controls. It doesn't mean that you can just move Bitcoin without any of your partners' permissions. So you would log into your account. You would see again the amount of Bitcoin you have sitting in your wallet. You click withdraw. You're going to be able to send Bitcoin to any address that you please and any amount of Bitcoin that you'd like. And from there, you'll have to go complete a verification process. So you and your partners from the gate of establishing this relationship would have designated an owner on the account. You can designate admins on the account that have every permission that owners do, besides the ability to video verify with OnRamp and BitGo. And then you have view only. You can add view only users as well. So if there are other employees within the company that you wanted to have that transparency directly on platform, or perhaps there's some very sizable LPs that demand additional transparency into the holdings to participate in the fund, you can give them view only access to the account as well. And so working through that withdrawal process, the account owner or the admin would tee up the transaction. So you would designate the address that you want to send Bitcoin to and the amount of Bitcoin you want to send. Someone else will have to, that did not initiate it. So either another admin on the account or an owner will actually have to verify. So there's that maker checker in place before the transaction can even be sent into the system. And then after that's approved and the maker checker is complete, then the owner on the account will have to video verify with OnRamp first and then separately with BitGo. And so this is important, right? Because at the end of the day, multi-institution would really fall short of what it could deliver if everything was done directly through OnRamp. If it was, I spoke to Chris at OnRamp, and then I tell BitGo that I spoke with Chris and they sign on your behalf. That would defeat the whole purpose, right? Because then OnRamp would have far too much influence in the process of managing the Bitcoin. So again, it's unified to the extent that you log into your account. It's going to be an OnRamp dashboard. You're able to buy, sell, deposit, withdraw, name admins, view only, etc. on the account. So have those role-based access controls. But when you actually go to move the Bitcoin, you'll have to speak independently with BitGo's trust operations team to verify that it's legitimate, you're not under duress, etc. So it's actually a bit of a cumbersome process, but it's by design because you don't want anyone getting access, unauthorized access to the Treasury.
And I imagine that's going to be even more important with the emergence of AI and deep fakes and that kind of thing. So, that's good that you have two video verification. Now, do the other, I know you're just using BitGo here. Do you have to verify with any other custodians part of
So in
that?
this, yeah, so in this case, Kenny, it would be on ramp first. You would speak with a member of our operations team first to verify, and then after that, you book time with BitGo's operations team. So you need two of three institutions to sign, and that's the way that workflow works. So there's OnRamp is the primary signer and the relationship manager. BitGo's the secondary key signer, and then CoinCover's the recovery key. So CoinCover, the UK-based company, they're not signing unless something
Gotcha.
happens to us, and there's a well-defined process that we stress test frequently on how that all works. And the other thing, Kenny, I just want to mention too is you mentioned the deep fakes and just threat from technology and artificial intelligence advancing pretty quickly. So one thing that clients could actually opt for as well is having an in-person verification on their account. So that would be with OnRamp specifically. Can't service that with BitGo, but as the first line of defense, you could actually opt in for meeting our team in person to verify rather than video.
And can you set thresholds? Like, so, maybe you want video verification for certain limits, and then if you're going to move a larger amount, you may want an in-person verification.
Exactly. Yep. So you can set thresholds and then you can set other types of bespoke controls as well. So for example, you could have let's just say for simplicity's sake, there's 100 Bitcoin in this fund, and for more than 10 Bitcoin to move in a given month, right? You have to actually go in person. Or another example could be a time lock. So if you want to move more than 10 Bitcoin out of the vault, there's a 7-day business delay before you can video verify with on-ramp. So there's definitely bespoke ways that we service our clients, just depending on what their needs are.
Seems like you guys thought this all the way through. Seems like there's a lot of a lot of ways that you can customize it for your particular use case. So this is all great news.
You bet. Yeah, I mean, it's just by nature of who we work with at the end of the day. So we work with business. It's predominantly, you guys might be surprised, predominantly individuals. So probably 60% of the business is individuals, but they skew to be more high net worth individuals in, let's say, in Bitcoin terms. And anyone can get a sense of who we work with just on our website. But then the 40% would be businesses, institutions of various types. And just by nature of working with these people, Kenny, everyone has human support here. Everyone can reach out to someone on our team and actually get on a call, usually same day, have a conversation, get questions answered. It's not like call centers, chatbots, or any of that. So we take the same personalization and bespoke nature to the security process as well for clients that choose to.
Maybe we take this opportunity to maybe pivot the conversation a little bit here and cover the lending partnership you guys have, because I'm excited to hear about it. I mean, the lending and just the broader capital stack is a reoccurring topic in commercial real estate, as you can imagine. And we've covered in the past the concept of the dual collateralized loan. Companies like Battery Finance had a deal first quarter of last year in Philadelphia, where they used Bitcoin as the secondary layer of collateral. That got a lot of press in the real estate world. But as I understand it, you guys have a new partnership and kind of a different product to offer that, maybe it's not a traditional real estate guy that needs it right out of the gate, but maybe somebody that already has a Bitcoin stack that is, trying to utilize it for real estate purposes. I don't know if I even said that correct. If feel free to correct me if I'm wrong there.
No, that's accurate, Chris. So we partnered with Arch. We've been working with them for a year at this point, maybe a bit longer. And Arch provides Bitcoin backed loans. And so, look, I would say we went through a process of having to canvas the industry in terms of reputable partners on the lending side, because we lived through 2022. And so, for anyone who wasn't around for that, the short of it is a lot of companies blew up and a lot of people ended up losing a lot of Bitcoin, unfortunately. Right. And so, as a business, we really had to make a decision. Do we want to offer our clients the lowest rate possible, with maybe some of these hidden risks or additional counterparty risk you're taking on? Or do we want to vet the partner that really matches our conservative nature as a business, how we manage risk, how we treat our clients? And so through that process, we landed on Arch, and I'm really comfortable using them and sending clients to them because for a few key reasons. First and foremost, again, we're talking about segregated wallets, meaning if you are a client of OnRamp and you want to get a loan with Arch, you can have a segregated wallet, so your Bitcoin's not commingled with other clients. It's again 24/7 visible, verifiable on chain. At this current moment, it's custodied with Anchorage, which is one of the more reputable institutional players in the space. But part of the partnership is we're building out multi-institution loans, which of course really excites me in our business because I think that'll be an incredibly big differentiation for the industry. That'll be the first ever Bitcoin-backed loan available and secured by multi-institution custody. But even now, as it stands at Anchorage, more comfortable given the relationship is bankruptcy remote. So if anything were to happen at Anchorage, there's no sort of clawback on client collateral and assets. And then it's also through Lloyd's of London insurance policy as well, which we have a different policy here at OnRamp for all of our clients. And at the end of the day, actually, good news on the rate side. Rates are now starting at 8.5%. So when we first started working with Arch, they were well in the double digits. most of the industry was higher than it is today, but you have rates starting to come down across the board. I think it's just becoming a more and more competitive industry. And also, there's more and more players in the traditional finance side who are interested in providing capital for this use case. And so that's another thing too, is like when you work with some of these Bitcoin backed loan providers, there can be duration mismatch because a lot of these providers are sourcing liquidity from retail lenders. So it's like ultra high net worth individuals that have a lot of Bitcoin or family offices are actually lending their Bitcoin. And those platforms are providing that for people who want Bitcoin backed loans. But you can imagine if you're a private lender, you may have a different duration in terms of assets, you wanting your assets back than the borrower does. And so Arch is actually sourcing very large pools of lending dollars from large institutional traditional finance players, and they tranche it out into CLOs. So people are taking on different type of maturity within that structure. But at the end of the day, it's like, again, it's simple. It's verifiable on chain, segregated wallets, bankruptcy remote, insured, moving to MIC, multi-institution custody, as soon as possible once we get that built out. And then rates are at about 8.5%. Duration is flexible. It's up to 12 months right now with the low rates. There's no prepayment penalty risk. You can term it out at 12 months without having to pay back that principal. So it's pretty flexible. And at the end of the day, in terms of conservative ways to manage Bitcoin backed loans, it's, I think, best in the business.
That's great. I think the use case for real estate with this product, it would be like a bridge loan. So short-term financing to do construction or an acquisition of a property. And when you look for financing, normally that can be higher. Like you can see double digits. So it seems like you guys are already competitive for that use case. I mean, the term is still short. It's a 12-month um, term. I don't know what the plans are for Arch to extend that, to something, maybe a 10-year note would be more palatable for a real estate developer type. I don't know if you guys have had those discussions.
Yeah, I wouldn't be able to speak confidently on that, Kenny, just
Hmm.
because I'm not sitting on the Arch team. But what I can say, having worked with a lot of clients that have taken Bitcoin back loans, is when you get up to that end of the term there, you can certainly roll over into a new term, and that's not a problem at all. And again, you don't have to pay principal back. So pretty flexible there, but I agree with you. It'd be exciting to see how this industry can develop in terms of providing longer duration. At the end of the day, it's about finding the lenders that are willing to lock up for that term, which I think is still a challenge. At least most of the terms I see out there typically are longest dated for about 24 months.
I mean, I'm just thinking, even with the shorter duration, I mean, Kenny, I think you hit it on the head with, kind of that bridge loan, perspective, right? And the thing that comes to my head is tenant improvements, right? We talked last week extensively about vacancies and the costs that landlords are absorbing on the front end to get a space re-tenanted. So the tenant improvement cost, the construction that goes into that is one of those costs, and as well as the broker commissions, the marketing fees, all of that. So within that 12-month duration that you're talking about, Jackson, this becomes a very real solution for operators. And then, almost the next step, Kenny, is, if you have your digital rent via STRC that's paying, 10%, there's a little bit of an arbitrage there that you can capture as well, or, maybe just sleep a little better at night. But yeah. I know we're coming up on time here. Any closing thoughts, Jackson? Anything we didn't maybe touch on?
Nothing comes immediately to mind. I would just encourage anyone who's a little bit greener to the space to really weigh the decision of thinking about custody because, again, Chris, to your point earlier, these investors are already thinking about their counterparties as they manage their fund structure, syndicate, et cetera, their properties from a banking perspective. But again, it's really ever more important when it comes to Bitcoin. So that's why we have a business. If it wasn't important, we wouldn't have a business. But you have 21 million, you don't have bailouts. And Look, people have lost hundreds of billions of dollars. The industry has collectively lost hundreds of billions of dollars, and it's not that large of an industry. If you take all of Bitcoin and all of crypto, it's about whatever 3 trillion or so. So there's been a considerable amount of losses in this space, and it's, in my opinion, because we're trying to map on solutions that exist in the traditional finance world to an asset that is absolutely scarce and digital. And when you try to do that, there's going to be a lot of hiccups and bumps in the road. So I think we're finally at a point, on-ramp aside, just as an industry in general, starting to actually figure out what works and what doesn't from an infrastructure perspective, and what that'll need to look like to actually power Bitcoin adoption and take us from where we are today into, a decade from now.
Love it. And just last question here, do you have real estate investors or real estate operators that you guys are working with, or?
Yep, we do. And so if anyone is, I'm sure some of these clients would be more than happy to have a conversation too, just to let you pick their brain and give them honest feedback on what their experience has been like. So we certainly do. And if anyone wants that that referral or touch base, feel free to reach out to me. I'm happy to get you in touch.
Awesome. Thanks, Jackson.
You bet. Thank you, guys.
All right. That's it for today's episode. If this conversation was useful, please share it with a partner, client, or someone making real decisions in the marketplace. New episodes drop weekly. Until next time, stay disciplined, think long term, and stack sets. Thanks, everybody.